what it means is if you've got low productivity growth, that lowers the nation's speed limit. It lowers the speed at which the supply side of the economy expands. So if you're pumping demand into a supply constricted economy, you get price rises. So ultimately, we're in this kind of stagflationary economy where we've got very low growth, but also high inflation. And now the RBA is responding with high interest rates, even though growth is poor. And we've got basically, our real wages are now tracking at the same levels that were in 2011. And Australia's real per capita household disposable income has been significantly lower over the last decade. Like the growth has been incredibly poor. It has been well below the OECD average. In fact, if you don't mind, I'll just quickly chuck up some charts. They'll only take 1 sec to get there.
Sure.
Because it just shows this. So I've got to scan through. Here we go. So on the left-hand side, Australia's real wages. So the blue is actual, red is the RBA's forecast based on the statement of monetary policy. So our real wages, the RBA thinks that by mid-2028, the real wages in Australia, so that's the wage price index, which basically measures the growth in wages job for job, so it compares the same jobs. It's going to be by mid-2028, real wages are going to be tracked at the same levels they were in March 2011. So it's pretty dire. And real per capita household disposable income, which is the middle chart there, I plotted that this week. This is up to the September quarter from the OECD. In the last decade, or between the March quarter of 2015 and September quarter of 2025, so that's 10 and a half years, Australia's growth in real per capita household disposable income has been lower than Canada, the United States, the UK. Those are the only English-speaking nations they had. New Zealand wasn't in there. But also significantly below the OECD average of 20% over that period, which is showed in red. So we're stuck in a low income trap in Australia, and that's really a low productivity trap because, as the chart on the right hand side shows, that's from Justin Fabo and Apodi at Macro. Australia's productivity growth over the past decade, this labour productivity, so that's basically how much goods and services you produce per hour of work, has also been amongst the very poorest in the OECD as well. And the fact of the matter is, if we don't have productivity growth, or we don't have decent productivity growth, we're not going to have decent wage growth or decent income growth, because that is the bottom line. And the fact that the reasons why we have such poor productivity growth we have is we've had excessive levels of immigration for 2 decades, again, overrunning, which has been higher than business investment, higher than infrastructure investment, and it's been greater than our ability to build homes. And that's just created lower productivity across the economy and higher inflation in things like rents and that sort of thing. We've had, obviously, energy policy failures. We've driven up the cost of energy, which has made our manufacturing sector shrink and added costs throughout the entire economy. That's made us less productive as well. And then obviously we've had this huge expansion of the non-market economy, like the NDIS, and got some charts here quickly. The top left is the expansion in the non-market economy since the start of 2023. That's from Alex Joyner. That's shown in orange. So most of our job growth has been in the non-market sector. The chart next to it, the second on the top, gross value added per hour work. That's another labour productivity measure. You can see in the non-market sector, it's been falling and it's tracking the same levels it was 2 decades ago. That's pulling down on productivity growth. We've had capital shallowing, which is the second chart from the right at the top. That's from Jared Minak. That's basically the amount of capital per worker has shrunk because we've grown the population faster than business investment and infrastructure. And the chart next to that, again from Alex Joyner, shows that the investment in new machinery and equipment is tracking at about half of what it was back in the 80s. Yet we've had population growth that is well above what it was in the 1980s. So businesses are adding machinery and equipment at a far slower rate than we're adding population. And that just means that we're getting less capital per worker, which makes them less productive. And I'll just explain that very quickly, just as in a stylized example, so people know what I'm talking about. If you run a cafe and you've got 2 employees working a coffee machine, and they can together churn out 100 coffees an hour, if you double the number of staff and you don't even double the number of coffee machines, so you've got 4 people working one coffee machine, you can't double your output to 200 coffees an hour because they're sharing the machine. There's congestion. They've got to wait for the other person to finish, etc. And as a result, their productivity per worker shrinks. That's effectively what's happened to the Australian economy. We've grown by 9 million people this century so far. Through high immigration, we've pumped heaps of people in, but we haven't grown. We haven't added the number of coffee machines. Well, I'm just using that as an example. You know what I mean? The investment into the economy to keep up with that population growth. And as a result, the capital stock per person has been shrinking, or the growth in that's been shrinking, and that's harming our productivity growth. And that is fundamentally what capital deepening, which is basically when you grow your machinery and equipment and technology faster than you grow the labour force, has been the primary driver of Australia's productivity growth since the Second World War, and also advanced countries around the world. But in the last 20 years, we've actually gone backwards on that measure because we've added people so far more quickly than we've added business investment and infrastructure. So that's one of the main reasons why Australia's productivity stinks. And because it stinks, we're stuck in this low income trap. And one final point, obviously, they got the energy story I've got here, which the bottom left shows that energy prices have surged and that's shrinking manufacturing and etc. But this chart, second from the left on the bottom, is one I put together, and I've basically plotted the immigration rate. I've inverted it, so it's down is more. That's the green line. As the immigration rate's gone up in Australia, so we surged immigration, we more than doubled it in the mid-2000s, and we've kept it high ever since. Australia's GDP per capita growth and our productivity growth, because of that capital deepening thing I was telling you about, the capital shallowing, has fallen. So running a high immigration policy is absolutely stupid if you want to grow your productivity and living standards. But that's what Australia's been doing. And there's one final point I should have mentioned is obviously we're with Australia's housing system, that's shown on the far right as a sort of example of it. But we, as a country, have pumped too much capital, the nation's capital, into established housing. So obviously we've got some of the most expensive housing in the world. We've had a massive surge in home prices for the last 25 years, well, close to 30 years, really. And our entire economy now has morphed into being far too concentrated in housing. So this is just one example. Back in the early 90s, banks lent 2/3 to businesses, and they only lent 1/3 for housing and for personal lending. Now, that chart on the bottom right doesn't have the personal lending line because that hasn't moved much. But now banks lend roughly 2/3 to mortgages and only 1/3 to businesses and personal lending. So we've completely inverted the economy in 40 years. And that just, again, is one of the reasons why business investment is so low in Australia at the same time as we're running high immigration, which then circles back to poor productivity growth. So I've gone on a bit of a rant here. But.
No, it's a good rant. I think it's an important one, but I do think that it comes down again to the taxation system. And this is the core argument of Georgism, of which, I keep going back. I'm, the former president of Prosper Australia, was that for over 10 years. But the idea is that the tax system dictates how you invest. And what we do in this country is we tax income and productivity very high. So it's a punishment on earning and producing things, which is the real economy, which is what you're trying to point out in these charts. And we encourage people to speculate in housing, not only to speculate in housing, but the idea is that you own your own home by the time you get to retirement. So from the word dot, people are basically breastfed on the notion that getting a leg onto the mythological housing ladder is a way to build their wealth rather than working and producing things. And that is the system of the tax system. And it's part of what we'll go on to talk about when we come to CGT. But I think that the other aspect of this is that people don't realize how that impacts land use, because there's a lot of talk about, this is the cost of the deadweight taxation, which is basically the productivity cost for taxing income and capital very highly. What that actually does, it discourages people to work, it discourages people to employ with payroll taxes, whatever it is, it has a negative impact on the economy. Sales tax, or means that you produce less or you have to put your costs up, one or the other. And they try and calculate that as a deadweight cost, and there's all these studies. I think KPMG did a whole paper, of how much it was.
Henry Tax Review did it as well.
Yeah. but they don't actually look at how it impacts land use. Because just as your example of the person that, can't afford to get the extra coffee machine because, they're running a coffee shop, there's hundreds of coffee shops in
Yeah.
the nearby
And
vicinity.
the rent on that coffee shop is super expensive. So
The rent's very high. They have to pay income taxes. They have to pay payroll taxes. They have to buy all the equipment, of which they have to pay sales taxes. On top of that, they have to pay their rents. Whereas if you get, I know we're moving over to electric cars, but it'd be the same idea. You get a gas station where they have a monopoly because there's only so many of them and the cars have to pull in there. You've got the self-service tills. They only have need maybe one employee in the shop during daylight hours. It basically pushes the smaller players out of the market and gives more monopoly power to the bigger players, like the bigger supermarkets where everybody gravitates towards, so they don't have to go to 10 separate shops anymore. So this idea of, how taxation, the negative loss, the deadweight loss of taxation, they try and calculate it per tax, but what they miss is how it's actually impacting land use. And then we get to a situation where the government realizes that the only way we're going to keep an economy that is pinned on property growth, and as you say, the bank's lending predominantly against property, which is why the system has to collapse on itself at the end, because property prices can't just keep going upwards. There has to be a reset at some point. At some point, the debts become too much for people to be able to service. It's not taking in, they have to run it on population growth. It has to be a Ponzi system. There always has to be a new buyer to buy in at the bottom end. There always has to be somebody with money to buy at the bottom of the pile in order to keep the party going, so to speak.
can I add something to so 100% right, the tax thing, but it's even worse than that. And I'll tell you why. So obviously we've got a tax system that incentivizes overinvestment into housing, right? That's pretty obvious. But also we've got a tax system that then encourages the federal government to run a high immigration policy. And I'll tell you why that is. So, and I'll use Norway as the counterfactual. So Australia is obviously an incredibly rich resource country, but we don't tax our resources properly. And as a result, our tax system is super reliant on personal income taxes. Right? Personal income taxes is the largest and it's the fastest growing area of taxation. And the federal treasury, which collects 80% of the nation's tax revenue, sees, because we're so heavily reliant on personal income taxes, they're like beauty. We can just bring in a whole bunch more people through migration and we can bring in way more income tax, which is what they do. So the Australian Treasury runs a high immigration program because they can bring in hundreds of thousands of people every year who work, who then generate income taxes, which the Australian Treasury captures. But they don't bear the cost of that high immigration because the cost of the high immigration predominantly falls on the states, which have to provide the infrastructure, the education, the health services, and most of the other stuff falls on the states. Also, it falls on us as private individuals because the states then sell everything off, and then we've got to pay user pays fees to go anywhere, which then basically means we pay private taxes to, say, Transurban to go on a toll road. When previous generations, you didn't have to pay for toll roads, etc. Now, here's the counterfactual. Norway taxes its resources properly. And that's probably the best example in the world of a country that actually taxes its resource wealth properly. So Norway taxes its oil and gas exports from the North Sea incredibly high. And part of that's because they've kept a lot of it in public hands. And as a result, Norway has a country of 5.5 million people, has created a sovereign wealth fund whereby it basically has got all the tax revenue and all the royalties from its oil and gas. It's funneled it into an investment fund called a sovereign wealth fund, which then invests overseas. It's the biggest shareholder in Microsoft and all these companies. And that sovereign wealth fund is now worth $300,000 US on average per Norwegian citizen. Now, because they're sitting on this massive mineral wealth, which they've generated by taxing their mineral wealth properly, this massive sovereign wealth fund, Norway has a direct disincentive to run a high immigration program. Because if Norway did what we did and say it doubled its population in 40 years or whatever, so it went to 11 million people instead of 5.5, well, then its sovereign wealth fund is no longer worth 300,000 US per citizen. It's worth 150,000. So you literally make your country poorer. But Australia does the other thing. We don't tax a mineral wealth properly, and we tax personal incomes punitively. So as a result, Treasury runs a very high immigration program because that's the easiest way to generate tax revenue without worrying about all the costs and all the other problems it creates. Because Treasury, that's not on the federal budget's purview. They don't care because that falls on someone else's ledger. But if Australia had taxed its resources properly, similar to Norway, or not even as punitively as Norway, but just way more stringently, Australia would then have a direct incentive not to run a high immigration policy, because when you bring more people and you grow Australia's population, you actually dilute your mineral wealth per person. Because what Australia sells to the world in iron ore, coal, natural gas, gold, nickel, manganese, all these other things that we export is independent of the size of the population. So if Australia's population was 20 million instead of 28 million as it is currently, we'd effectively have more mineral wealth per person. And if we tax the stuff properly, we'd have more tax revenue per person from a resource wealth. But if we grow the population aggressively, you get less tax revenue per person. But unfortunately, this sort of circles back to how we've devised a tax system that creates bad outcomes. It creates bad outcomes because you get overinvestment in housing rather than productive investment, which actually grows the economy. So you don't get enough business investment, not enough infrastructure investment, you get too much in housing. You also have excess demand for those things that you don't have enough of by running a high immigration policy, because that's the easiest way of getting personal income taxes, when the solution is to actually cut personal income taxes and tax things properly like land and resources. And if you did that, you wouldn't run a high immigration policy because that'd be self-defeating and detrimental. But this is just the way that Australia is just warped, the way we have a policy set in this country, and it just creates negative outcomes.